As has been the theme for the past few months of these updates on the state of the Greater Vancouver housing market, inflation and interest rates remain front and center. Inflation remains stubbornly high, and central banks are now panicking to rein it in. They're now tasked with the impossible mission of killing enough demand to bring down commodity prices without triggering a financial mistake or recession. Keep in mind, Canada has one of the worst balance sheets in the G20, with total non-financial debt to GDP at over 350%. Households, corporations, and governments in Canada are highly levered. Vancouver housing prices, they've benefited immensely off the cheap leverage, which is now going away, at least temporarily. Again, let's just run some simple numbers here. The benchmark price of a home in Greater Vancouver, that measures the typical cost of a typical home across product types, meaning houses, townhomes, condos. And right now that equates to $1,261,100 at the end of May. So assuming an 80% loan to value ratio on your mortgage with over 30-year amortization and a 5-year fixed mortgage at current rates of 4.5%, that equates to a monthly payment of $5,087. Run that same math and assume your mortgage rate is 2.5%, which it was the going rate 4 or 5 months ago, and that equates to an extra $1,107 a month on your mortgage payment. In other words, you're getting the same house as before, but you get the luxury of paying an extra $1,100 per month on your mortgage. Congratulations. It should therefore come as no surprise that housing demand has really fallen off in the last few months. Greater Vancouver home prices have dropped 32% year over year in May, or 11% of their 10-year average. Affordability was already an issue, and mortgage rates have only exacerbated this situation. Many buyers are now waiting, and they're hoping for prices to fall at least partially to offset the cost of borrowing. Nonetheless, the Bank of Canada is intent on moving forward, raising interest rates by another 50 basis points here in June. And listening to the Bank of Canada's press conference after the announcement, it sounds likely that they're willing to induce a recession in order to get inflation lower. So we'll see soon enough. While homebuyer demand has dropped off, the rental market is heating up. According to Zumper, one of the largest platforms in the city, the average rent for a one-bedroom condo is up 15% year over year, with the median rent at $2,300 per month. Based on my conversations with property managers, tenancy applications are surging, with applicants competing frequently. Anywhere you go, rental prices are on the rise. Suffice to say, if you are a landlord worried about the rising costs of mortgage rates, rents should offset at least some of that pain. Out to the suburbs, things continue to slow, but there's no panic. As we talked about in the last month's report, the suburbs are under pressure, but the rising mortgage rates and a boom that was inevitably bound to slow, those are both hitting at the same time. Fraser Valley home sales plummeted a whopping 54% year over year in May. Now sure, home sales hit all-time record highs in May, so this comparison is rather tough, but still, sales in May were 25% below their long-term historical average. It doesn't take a genius to figure out that prices are adjusting rather quickly. So here's a quick look at the correction that detached houses in the suburbs are facing. The median price declines from the peak are Surrey down 15%, Abbotsford down 14%, and Langley down 13%. What's most interesting about this price correction is that new listings for sale have remained quite muted. In other words, the price correction is not due to a flood of new listings. Sellers aren't panicking and flooding the market because of the interest rates going up. Quite simply, the demand has fallen. Sentiment has soured. And now that forces motivated sellers to take lower offer prices. I could highlight that we've seen a 17% year over year decline in new listings in the Fraser Valley for detached houses. In fact, new listings are running below their long-term average for this time of year. So new listings are actually quite low, but demand has fallen off quickly. This is best highlighted by the months of inventory, which has grown from a low of 0.7 in December to 4.6 months in May. Inventory can continue to grow even without a surge in new listings. It doesn't take a flood of panicked sellers with listings hitting the market to push prices down. It just takes weaker demand. Now let's talk about canceled projects that are incoming. The pre-sale market tends to lag the resale market, and as demand weakens in the resale market and buyers start to see prices coming down, it eventually slows pre-sale purchases. Now, considering the fact that investors account for the majority of new home sales, sentiment is important. The pre-sale market has been on fire for the past 18 months and it's now slowing. Now, what do you do if you're a developer and you see an aggressive central bank that is hell-bent on raising interest rates and weakening buyer demand and still elevated construction costs? Well, for many of these developers, the answer is to just hit the pause button, and that's now playing out. Keep in mind, in BC, developers typically need to sell out about 60% of their units within 12 months in order to remain compliant with the BC government regulations and in order to secure construction financing. If you are worried about hitting those targets and if you can't pass on either the rising cost of construction or pass on the financing cost to the end buyer, then you seriously have to contemplate the feasibility or profitability of a new development. So the key takeaway here is that not only are home sales slowing rather significantly, but we'll also soon see housing starts roll over. And this isn't good considering residential investment and household consumption account for over 80% of real GDP growth in Canada over the last 5 years. Residential investment in Canada accounts for nearly 10% of GDP, with the Bank of Canada hiking into a slowdown. Keep in mind, it's still very early, and it's something worth watching considering how large a role the housing market plays in the overall economy. The Canada 5-year bond yield, which prices the popular 5-year fixed mortgage, is now sitting at 3.1%, and this is the highest reading since March of 2008. If you walk into your bank today, the lowest 5-year fixed rate on your mortgage for uninsured borrowers is about 4.5%. We're inching closer to 5%. We haven't seen these rates in over a decade. And as we discussed earlier, this is the biggest reason behind slumping housing activity. A lot of people ask me, what should they do? Lock in a fixed rate mortgage or just stay with their variable rate? Well, if you know for sure that you're going to be in the property for the next 5 years, then fixed is typically the way to go. However, over 50% of Canadians end up breaking their 5-year mortgage before the term expires, often incurring huge fees to break that term early. So variable rate mortgages have typically been trading at a discount, especially more recently. Hence, why over 60% of new originations in the past year have been at a variable rate. What's important to understand is that most variable rate mortgages, the big banks besides Scotia and First National, are typically fixed payment mortgages. In other words, just because the Bank of Canada is raising interest rates, it does not mean your monthly payment will increase. That will stay the same. It'll just mean that you're paying more interest within that payment and less of it is going towards your principal and your mortgage pay down. Typically, the fixed rate variable mortgages, those can have a trigger clause of about 350 basis points. What that means is that if your variable rate was 1.5 when you first got it and interest rates go up to 4, this will trigger a clause in your mortgage prompting the bank to increase your monthly payment. While this is a slim probability for most, what's important is the following. When you renew your mortgage in 5 years, less of your principal will be paid down. The balance of the mortgage will renew at the prevailing rates, which will likely be higher. And your remaining mortgage balance, that'll need to be amortized over the life of your mortgage. For example, if you originally had a 30-year amortization, you will renew your mortgage at a 25-year amortization. In other words, you face 2 payment shocks, higher interest rates, and an outstanding balance that will now be amortized over 25 years, not 30. You can always try to refinance and extend that mortgage back to 30 years, but this will require you to re-qualify. If borrowers are worried about having a larger than expected balance and payment increase upon renewal, they can always do accelerated monthly payments to pay down the balance quicker. Some lenders will allow up to a 20% lump sum payment per year. Anyway, this is a lot to digest, but basically, homeowners are now facing rising mortgage costs on renewal, and this is quite rare given that interest rates have been falling for the last 30 years. Debt service ratios are projecting to hit record highs in Q1 of 2023 as a result. So we'll leave it at that for this month. If you want to learn more about the real estate market, more about what's going on with mortgages, pre-sales in Greater Vancouver, in the Valley, send me a DM, comment below, call me on my cell at 604-313-9805. We'd love to hear from you, love to get a conversation going. If you never want to miss another one of these videos, don't forget to subscribe.